Another potential black swan event may be on the horizon for US stocks. Recently, several Bank of Japan officials have sent out hawkish signals, hinting that a rate hike could come as early as December. Recall August of last year, the BOJ's unexpected rate hike triggered a global stock sell-off. Now, the big question is, will the reverse carry trade once again plunge US market liquidity into crisis? And will the traditional Santa Claus rally still arrive as expected? Welcome to Jingye's Finance Talk. With Japanese stocks continuing to climb and the weak yen fueling imported inflation, the timing of an interest rate hike has become a pressing issue for the BOJ. Over the past 2 years, the yen has depreciated significantly against the dollar, even breaching the 150 mark. This has driven up import costs, pushed consumer prices higher, and led to noticeable risk premiums across various asset classes. Moreover, with CPI consistently above 2% for several months, Japan has clearly entered an inflationary phase. As a result, the BOJ has recently signaled it may raise interest rates as soon as December. Why does a Japanese rate hike matter so much to global markets? Last August's surprise move triggered a Black Monday across global capital markets. US stocks, treasuries, European and Asian equities, and crypto all tumbled, causing heavy investor losses. The issue isn't the hike itself, but the chain reaction of global leverage behind it. For over a decade, Japan's ultra-low interest rates created massive global arbitrage opportunities. Hedge funds borrowed cheaply in yen to buy US stocks, bonds, and other high-yield risk assets, profiting from the spread, a strategy known as the carry trade. A classic example is Warren Buffett's Berkshire Hathaway, which for years has issued low-rate yen bonds to fund investments in stable, dividend-rich assets like Japan's top trading houses. In short, borrow in Japan, invest in Japanese assets. This cheap capital also flowed into other global markets, collectively inflating the prices of risk assets. But if Japan starts raising rates, this arbitrage window narrows or even closes. A stronger yen could force investors to sell risk assets, repay yen-denominated loans, and withdraw liquidity from global markets, potentially triggering a wave of selling by trend-following funds and creating a negative feedback loop. For US stocks, a December BOJ hike could bring short-term volatility, a fluctuating US dollar index, rising treasury yields, and a spike in the VIX. Historically, such conditions have often led to sell-offs in high-beta tech stocks, higher implied volatility, more expensive index options, and increased market swings, a repricing of event risk. That said, short-term turbulence doesn't mean a market crash. In the medium to long term, there may even be positives. Unlike last August's surprise, the BOJ is now prepping the market months in advance, allowing time to digest the uncertainty. After weeks of declines, US stock leverage has already decreased, and the scale of carry trades is less extreme than last year, making a chain reaction meltdown far less likely. Subscribe for more timely market analysis and insights.